All right, let's get right into it. Today, we're doing a deep dive on a pretty fascinating tool called the Windex Indicator. And we're not just talking theory here. We're going to break down a detailed performance case study on one of the most traded assets on the planet, gold, or as you know it, XAUUSD. This one sentence really captures the entire philosophy we're about to unpack. It's a fundamental shift in thinking, moving away from that frantic chase for the next random entry signal and toward a deliberate, methodical search for structure within the market. And that really brings us to the core challenge that pretty much every trader has to deal with, right? How do you separate a real repeatable strategy from just, well, getting lucky? For a lot of people, trading it looks a lot like this. It's kind of chaotic. It's trading without a real method, jumping into positions based on impulse, hopping from one asset to the next, and making that classic mistake of confusing a wild, volatile market with a genuine opportunity. Honestly, it's just a recipe for inconsistent results and a whole lot of frustration. So this is where the Windex approach aims to be different. The whole idea is to replace that chaos with clarity. It's about taking a raw, unfiltered reading of the market and transforming it into a series of disciplined, deliberate actions. Okay, so enough with the philosophy, let's get to the main event. The proof really is in the numbers. We're about to walk through the actual concrete performance results from this focused case study on gold. This study started with an initial capital of $25,000. So that's our starting line. And from that starting line, the total gain achieved was a really impressive 40.3%. Now, a percentage is great, but what does that look like in actual dollars? Well, it translates to a realized closed-out profit of just over $10,000. And, for the sake of complete transparency, it's really important to mention that this was all done on a demo account. This is just standard procedure for R&D. It lets you isolate the strategy's performance and analyze it without all the other variables of live market execution getting in the way. And this is where you can really see the story the numbers are telling. This capital curve is beautiful. It shows the journey from that initial 25 grand all the way to the final balance. And notice, it's not some crazy jagged line full of heart-stopping dips. It's a clear, consistent upward trajectory. So the big question is how? How are these results possible? Let's pull back the curtain and look at the method behind the performance, which really boils down to two things: focus and discipline. All right, so over the entire study, a total of 124 trades were taken. But look at this breakdown. 95 of those were long positions, basically bets that the price was going up. Only 29 were short or sell positions. Now, that is not a random split. It tells you the indicator did its job. It correctly read that the market structure during this period was overwhelmingly bullish. And this is absolutely crucial to understand. This is not an automated robot. The Windex indicator provides the high-level market reading, the structural analysis, but the final decision, the execution, is 100% manual. It's a tool made to empower a disciplined trader, not to replace one. This right here highlights a core principle: the power of specializing. Every single one of those 124 trades was on one asset, and one asset only: gold. This kind of absolute focus lets you develop a much, much deeper understanding of how that one asset behaves, which gives you a huge strategic edge over someone who's trying to trade everything under the sun. Okay, let's talk about the one topic that's always on a serious trader's mind: risk. But we're going to look at it a little differently, not as something to be afraid of, but as a variable that you can manage intelligently. This leads to that critical question that I'm sure you're asking right now. That's great, but what happens to the account's value while the trades are still open? This table shows that distinction perfectly. The balance, that's your final locked-in profit after everything is closed. But the equity, that's the real-time floating value of your account while trades are still active. And of course, that's going to fluctuate. Internalizing this requires a major mental shift for any trader. The goal isn't to be terrified of drawdown, that temporary dip in equity. It's about fundamentally understanding the difference between a fluctuation during the journey and the final closed result. One is just part of the process. The other is the destination. And this number right here just illustrates that control perfectly. A deposit load of just over 3%. What that means is that at any given time, only a tiny fraction of the total capital was actually being used to hold open positions. That shows incredibly responsible leverage management. It's really the hallmark of a professional, risk-aware approach. So, when you put it all together, who is a tool like this really built for? Well, it's definitely designed for a specific kind of trader, one who values precision over all the market noise. The contrast is pretty stark, isn't it? The Windex approach is really for the trader who's ready to move from guesswork to clarity, from trading on impulse to executing a method. It's for people who want to filter out all that noise, focus on discipline, and finally replace a reliance on luck with a skillful, repeatable reading of market structure. So if this structured, data-driven way of looking at the market resonates with you, and you really want to understand the deep logic that can drive this kind of performance, the conversation starts here. Thanks so much for your time.